Ladies and gentlemen, let's all welcome Call's Chief Technical Analyst, Mr. Juanis Barredo.
Good day, everybody. Thank you for taking some time to be able to join us in our objective today, which is to be able to have a look at how markets are faring and see what we can do with them as time goes on. I know a lot of you right now are probably at your homes, probably trying to figure out what to do since you've been there perhaps more than a week right now. Our markets have been falling down since, and I'll try to be able to explain some of the technical aspects of what we've been looking at so far. For those of you who have not seen, a few days ago, we also had a webinar, and our head of research did be able to do a presentation. Some of you might want to be able to have a look at that so you can also see the fullness of what the fundamentals have in terms of this. And you might find it very, very insightful. So please go ahead and have a look at that webinar that we've had. So today we're going to try to be able to run through what the technical conditions look like. So let's get right into it. All right, so today we're talking about how we're going to be trading in today's market volatility. Given the fact that we've seen quite a number of declines in the market, it didn't really matter what stock was out there, whether it was a blue chip or a mid cap or a small cap. We did see quite a bit of a decline in levels that we've not seen in many years. And given the context of this type of decline, I guess many people are saying, what's going on? How long is this going to last? What do I do in this type of environment? And so let's try to be able to pick up on many of those questions. Today we'll talk about what happened, how is it affecting markets, what can happen from here, what technical pattern should we be watchful of in case it might generate some signals for us to be able to put in a trading window. And what do I do in the interim? I'm assuming I don't see any change, or assuming I'm seeing some trend changes. How do we come around to be able to see these things? And we also want to be able to try to be able to make good sense of things so that we can keep very much in mind what we have to do and what safety nets we have to do in case we do decide to be able to take some of the opportunities that the market is showing us now. So what happened today? I mean, yes, I'm sure everybody's heard about this plague that's going on called COVID-19. This is what we call a black swan event. Why a black swan, you might ask? It means it's an event that nobody saw coming, right? And it hit us and hit the rest of the world quite surprisingly. Nobody really got to prepare for this. The economic impact of this, we still have to be able to realize what type of damage it's going to do and how long. Is it going to be something experienced in the short, medium, or even long term? And because of all those questions, markets have been saying, look, I don't know how to be able to deal with this. So many people have been selling their positions, and that's quite, that pushed markets down quite strongly. And that's why you've been seeing a lot of even very, very ridiculous types of declines, some of which are probably forcing prices way below what their fundamental values are. And not because they're supposed to be there, but only because investors need to be able to generate a handle on safety for their investments. And they've just sold it to raise some cash because they don't know what to expect from these conditions. I guess the questions everyone's is really asking is, how long will this last? And if it doesn't last too long, then this opportunity that the market is showing us right now should be something that we should really try to take advantage of. Also, it's quite possible along this period of waiting we're doing, somebody out there will come out with a particular cure. And even if that cure perhaps is not disseminated a lot around the world immediately, the mere fact that everybody knows that a cure is finally in existence would probably be sending your market way much higher already. So in these conditions, you have to be ready, and you cannot just say that, I'll just wait for all these things to blow over and see what I'm going to do. Because if you do that, the opportunity of a lot of the discounts you're seeing may no longer be there. Now let's begin first with what happened with markets. You can see the slide that I'm showing you here. You can see it doesn't really matter where you're from, but all markets around the world did pull back. It's quite surprisingly, though, that the place where this all started didn't pull back as much as the rest of the world. but it could be because the Shanghai index have been actually falling down for quite some time already, and this is the reason why perhaps that they have not been experiencing this. Also, it's only now that the acceleration for the rest of the world is actually starting to be able to show itself on, and Shanghai's index is probably responding to the fact that we've already seen maybe 2 or 3 months of this exposure, and their market seems to be getting used to the idea that this exists and that perhaps the case is not accelerating anymore, and that's why perhaps the Shanghai index seems to be a bit more resilient than the rest. But the situation elsewhere is quite dire for markets. The PSEI has fallen, to a degree just this year. For this year, is about 40%. Even the MSCI World Index, which looks at a basket of many different indices, ex the US, is also quite down quite a bit. So given that we're all in the same boat here and everybody's still trying to play catch up with the situation, let's try to have a look at what particular things happen with the other markets as well. So on the left hand side, you probably see the S&P 500. I've looked at data here since almost maybe 11, 12 years ago. And the reason I looked at that time frame is really because this is when the bull market began. So if you can see the utmost low point that you have over here, this is the 2009 low that we saw in the S&P, and that market just went practically straight up to almost the high that we've seen sometime actually this year as well. And after that, it just went vertical into a nosedive. Now, it's hitting its first Fibonacci support level closer to 38.2%. So it's quite possible that maybe we could probably be seeing an interim rebound for the US quite soon, if not already. We've also noticed that the US is also now implementing a lot more reforms and stimulus packages. And I think last night they just even announced that it's become open-ended, and they say they're going to do anything to try to be able to shore up this economic situation. So it might be a good time to be able to experience some type of rebound in reaction to these types of stimulus that the entire world is doing as well. On the right, you can see the German DAX. Now, the German DAX is showing you the conditions that were pretty similar to what happened to the US as well. And if you probably look at it, it's actually fallen much more than what the S&P had done. It's already coming close to almost having a 50% pullback of the rally that it made from 2009 to where we are today. So given the context of that, might also be encountering some degree of support soon. But this might also some rallies for the meantime, but it doesn't mean that the decline is ending. This could just mean that markets have been extremely oversold, and they may need to be able to do for some sort of counter rally for the moment. Looking into US bond yields and the dollar. Now, why do we look at bond yields? Bond yields tend to represent the opinion of investors towards interest rates. So if you see what's happening here, you see bond yields are falling down quite steeply. You actually can't see on the left side, but what you're actually seeing is that bond yields have gone down to an all-time low. And to the degree that we're standing below 1% right now. And I've looked back in my data since 1960 and 1950, and I've never seen bond yields that low. So it's just trying to be able to tell you how frightened the investor is out there, that they feel that perhaps more rate cuts will probably be likely to try to be able to generate more stimulus. And this bond yield is moving quite forward in terms of that anticipated move. The dollar has actually taken a very strong command of prices recently. Although there was a time where it looked like it was about to correct somewhere over here, but then the US dollar index just jumped up very, very strongly. If you're probably wondering what's going on in the US that managed to do this? Well, in reality, what you're looking at here is a US dollar that is strong because all the currencies that trade against it are actually weaker, particularly the euro. And so when the euro is actually weakening faster than the US, then you will still see a very strong involvement in the US dollar like the way it is. So it's really what you're seeing is that you're seeing a lot more weakness in other currencies. And that's the reason why the dollar has been relatively strong compared to the rest. Oil prices. If you look at oil prices here on the left side, it looks like quite similar to what bond yields are also showing you. Oil is falling down because people are quite worried that businesses may get disrupted and that the demand for oil may substantially fall down in the course of this activity. In fact, it's fallen already close to about $25 per barrel. And given the context of this particular decline, again, it's also showing you the anxiety that the situation that is being shown by everybody else. And here on the right side, we have gold. The gold seems to be the only commodity that seems to have been on an up move during this entire recovery. Yes, recently we've seen it pull back a little bit, but perhaps because it went up quite sharply from 1,300 all the way to almost 1,600, but still showing a general up advance. This could be because people are probably worried about all the other volatility they're seeing in other currencies, and they're trying to weigh out that gold may be a more stable thing to be able to hang on to during this period where there's a lot of unrest and instability for other markets. So I think that gold might decide to probably cascade more. But collectively, all these signals that we're looking at is still telling us that the markets are quite worried about things. Now, are we exaggerating things already? Perhaps it is. And because of that, we hope that in the short term that we could see some degree of rallies to be able to interrupt all these declines that we're doing, and they should be able to offer some degree of possible short-term trading for some traders as well. Now let's look into the Philippine Stock Exchange Index. If you were to compare us compared to the rest, I think you can see a much heavier decline being shown by the PSEI as compared to the S&P 500 and compared also to German DAX, which we looked at earlier. And this pullback that we're seeing in the PSEI has been quite heavy, so much so that it's already gone down below 5,000, and these are reaching levels that nobody had dared anticipate in terms of its magnitude, clearly because of the black swan event that we're currently looking through. If you were to look at its foreign neighbor, which is EPHE, or the MSCI Philippine Index here on the right side, I just want to show you that the damage here was quite severe. I mean, after breaking down from this support shelf that we've seen, it just literally dropped like a rock. And in fact, it's already almost closed in on a low that it hit back in 2011, which is closer to about $19.92. So again, I really hope that this major low that we've seen back then can also provide some lift into the short term and maybe allow prices to be able to make or stage some sort of recovery. If that can actually happen, it may be able to help our local index try to do the same. So, you know, these thresholds we're seeing right now should prove to be quite crucial, and I hope that some degree of element of support can actually come in to foster some demand back. Now let's have a look finally at the Philippine peso versus the other Asian peers that it has. If we're looking at the peso dollar rate here on the left side, look at the relatively 1.5-year picture here. You can clearly see a downtrend still manifests itself in the into the peso dollar rate. As this heads down, that means your peso is still firming against the US dollar. Although in the last few weeks, you've noticed a big area pattern over here, consolidation, which broke on the upside. It jumped very quickly. It did it for about 2 days, and then quickly fell back down closer to 51 right away. So far, this firming trend of the Philippine peso is still quite intact. Although, yes, in the short term, it might probably need to be able to wind up a little bit more, and let's see if it will attack that 51.75 resistance again. But so far, there's been no change of its trend, and so far that would mean that there should be no problem so far into the movement of the peso. Now let's look at the peso compared to some of its other Asian currencies. And if you were to look at it, the peso is this black line that you see here. And compared to that, you will have, of course, the euro here right above it. You will have the Indonesian currency. You also have your Indian currency and the Thai baht. Now, if you notice, the Indonesian currency has been the weakest. I mean, it's actually depreciated 16% of its value into this year, and so it's been quite hard hit. So far, the peso seems to be the more stable currency that we're seeing here, and that should be able to keep investments from capital flight, because it seems to be holding on in its ground, and that particular strength should try to be able to keep investors inside our country. So that's one of the good things we see so far. But unfortunately, the effect into all our index stocks have been quite material. If you look at the list that I'm showing you right now, this is the list of the PSEI 30 member index stocks. And you can see as you go towards the right, you will see how much of a decline that we've actually seen in the last 3 years, since the 3-year top that we have actually looked at from these companies. And if you were to look all the way here on the right side, you can see some issues that are down maybe 60, 70% already. And it's really because of that also that I feel that the markets are coming to a point of exhaustion. However, it's still looking for something to grasp on. Why? It's looking for a reason to rebound. The problem is every day you probably look at the news and all you hear is about more cases of coronavirus patients increasing. And that keeps a lot of people at bay. And what's happening right now is a lot of this discount we're seeing to the fair value of companies have been grossly overdone. And I think sooner rather than later, we're probably going to get some interim rallies that you'll probably look at, something that can try to be able to decrease much of the variations we've seen in the price and the variances from the tops. So hopefully that could be able to provide another trading opportunity. As you can see, the PSEI index is listed here. At least it's about 47%, but you can see quite a bigger number of index stocks have actually gone down much more. And if you're wondering why that's the case, because a generous much of the weight of the index is actually because of SM and SM Prime, and maybe 1 or 2 more of these lists. And that's the reason why, of course, that the index remains not in the middle of this band, but somewhere in the left side of this band. Okay, so let's get a little bit more technical here. So the PSEI index, looking at it through some of the thresholds that I wanted to be able to point out, I've run to try to estimate where next support levels could be. Now, please remember that these support levels I'm showing you were not even levels I was even looking at in the beginning of the year. Now, because of the Black Swan event, trends have changed. The capacity for the seller to hold has actually been very, very weak, and they've been selling because all they've been thinking of is playing safety. And because of that, we've had a very aggressive decline. So we've hit close to an intraday low of about close to 4,000 sometime last week. There was a little bit of a rebound take place, but the first support level should be closer to about 4,500, right? And so that's not really too far from where we are right now. Now, given the context of that, I really hope that this level can probably try to shore up some support first, and hopefully we can generate a little bit of a rally of maybe a pause pattern. But just in case this thing decides to be able to sink back, that 4,000 might be another area that it may be retested. Or if some panicky situation were happening again, I think a maximum output in terms of decline will probably look at about 3,300. Now, if you're wondering where did I get this number from, what I did is I drew a line to connect the 2 major bear market bottoms I've seen in the past. One towards the early 2000s, and the other one which we saw sometime in 2009, which is this one you see here. And after connecting those 2 lows, a major uptrend line seems to sit closer to that 3.3 or 3.4 level. So this, I believe, should be a level that, if we even hit this, should already be a very meaningful level for many of you guys to be able to start to be able to generate some risk back into the situation, because this is not going to stay too long below this area. It's only doing that because of this extraordinary time. And if we do get that chance to be able to pick up prices there, please don't let this opportunity pass. So what do you think is going to happen? Our situation will be this way. I think in the market, for it to try to be able to return back into a recovery situation, we'll have to go through 3 phases. The first is what we call a selling capitulation, which we'll probably have already started. The selling capitulation I'll explain in a little while, but that's normally a very aggressive type of selling condition. Then it will go through a bottoming process. And the bottoming process, I will try to describe to you different types of bottoming types of patterns so that you can be familiar with what they look like. And so if you see them in some of your stocks, that you can be quite ready to be able to respond. And third, it will go and confirm a trend reversal signal. We're way off from this right now, but again, we need to know whether things have already cooled down and whether the market is already deciding to be able to start to recover well and more lastingly doing so. So we will talk about what a trend reversal means and what we can look at to be able to give us better view that this is actually taking place. So let's begin with the first particular phase or step. Now, capitulation. Now, capitulation is, in a sense, panic selling. People are ridiculously selling their positions because they're fearful of the general market condition. And no ounce of explanation is going to try to tell people to hold on to a stock when there's just so much problems around you that could be threatening, maybe in this case, even life-threatening. And it's because of that that people have been liquidating their positions with quite heated impact. And given that particular type of situation, you want to make sure that people are behaving quite emotionally here. And when people are selling, even at these prices, they're just really want to stop the bleeding. They don't really care about what the fundamental value is. They need to be able to raise some cash so that they can feel safe during this troubled times. And they're literally just selling things quite ridiculously already. For those who can take advantage of that, I mean, this is the time that you should be extremely watchful of any opportunity that can come from this situation, because this happens maybe once or twice in a lifetime. And given this context, this could be one of those opportunities we're looking at. Now, when we talk about capitulation, capitulation is not a single drive of a decline. It could take, a few accelerated portions coming through it. If you notice the picture that I put out here on globe, I wanted to show you that as the decline usually begins, it starts off at not so aggressive pace. Then it becomes a bit faster, and then it really becomes fast, even if prices are much cheaper. Again, it's not because people don't think that the market is cheap, it's just because their ability to hold is being compromised by the fear that they're actually feeling. And you can clearly see it because you can see that it's already becoming quite intensified, almost vertical in its decline. And that's very typical of what a capitulated selling would look like. And you will see this series of declines that would come into it. Now you might ask, what do I do in a situation like this? If I could turn time backwards and tell you, of course, better to lighten down already so you don't have to be able to make decisions in today's type of situation, I mean, that would have been, of course, a better cast. But we're currently in a situation perhaps looking at something like this. And given this situation right now, you really have to ask yourself is, do I have what it takes to be able to hold the position through and through? That you firmly believe that the valuations here are clearly much higher and that this is going to be a temporary event. And if you do that, then perhaps you might decide to be able to hang on to that. I'll talk about that strategy later when we decide whether you're short term in terms of your ability to hold or whether you'd be long term in your ability to hold. Now, what do we do? Technicians normally are trained to be able to stay out of a decline. And there's good reason for that. In a decline, it goes through a series of ups and downs and price pauses like this. And it looks like it may have been over in those two situations just like this, but then you'd see again prices will come back down and accelerate into the decline. One tool I'd like to use and introduce to you to be able to help navigate through this are moving averages. Today I will show you the 20-day exponential moving average compared to the 50-day exponential moving average. With everything I'll show you today, I'll just show you these two and try to be able to help you use them so that it can help guide you as to whether you should be staying out or coming back into a market. In essence, moving averages are good trending indicators. If you see them, what they're doing here, you can see prices falling down, and you can see that prices tend to be staying below the moving average, the 20-day, and even the 50-day moving average. As long as prices stay below these particular moving averages, the tendency for you as a trader is to be able to stay out of that market because it tells you that the downtrend remains intact. So when you're using this 20-day moving average versus the 50-day, as long as you don't see the 20-day cross up strongly over the 50-day and you just see prices staying below both, then the basic assumption here is to be able to stay out of the market. Now, if some of you are trying to be able to buy for a very, very short particular bounce, and you're thinking a grossly oversold situation like this can probably rebound well to make some good money in the interim, well, you can try to do that, but I would suggest that you do that with very, very controlled levels of volume. First, if you buy too much, you might have been able to survive the trade because a little pullback and you might get scared and you might toss it away. Second is also try to mitigate what you were anticipating as a target. Normally, if your price is down here and your moving averages are, let's say, above at this level or at this level, you should only be targeting either this or this as a potential rally, and that being the best of the situation. If you can see here, rallies were actually quite blunt, and only because people were able to buy at a very low price. Rallying this distance, some of those guys are taking in good percentage gains at this. So it does take some time to be able to get away from a decline such as this. And it is a process of bottoming out, as we will explain to you in a while. So the process of bottoming in terms of our market will probably show itself in a few forms. We'd like to be able to put some letters into these types of forms so that you can generally get a sense of how it can be easily described. So three bottoming processes. Let's call the first a U-shaped bottom. The second will be a V-shaped bottom. And the third will be a W-based bottom. Let's look at the first. Now the U-shaped base looks like this picture you see here. You see a downtrend, slowly slowing down, eventually going sideways, starting to get a bit more firm, and then eventually turning itself up and then moving back into an uptrend. Now this U-shaped base is a clear anticipation of a market that perhaps is not seeing a very rapid sense of a recovery. And this could be the case in our market because we don't know how fast that they'll be able to fix the problem of this plague going on. So what will happen here is we could probably get this type of impact. So if you look at a sample of MegaWorld in the past, you will see very sharp drops. Again, capitulation, a little rally, capitulation, a little rally. And here you can see a much more good orientation in price. So the minute you see that the volatility of the price seems to be narrowing down, that means that the range of the trading for the day starts to be no longer 5% or 10% in a day, but maybe goes back to normal in the sense of maybe under 2% or 1% in a day. And that tells you the market seems to be calming down. And if you notice in this U-shaped type of pattern here, you will see this gradual decline that will come in. No longer an intensification or an aggressive decline like you saw in the prior one. This will be your first clue that the market seems to be orienting itself and is getting an avenue of safety. And this is what you want to see in a U-shaped type of pattern that can prepare you that an eventual recovery and a more lasting one will actually come in. Now, a variety of this type of bottoming type of pattern is what we call a V-shaped base. That's called a V-shape because a V is much more sharper than a letter U. Where a letter U is much more gradual in its turn, a V-shape will show you a very, very, very sharp recovery after this capitulation had taken place. Commonly, a V-shape will look like something like this. You will see that the V-shape will move gradually first, accelerate down, and more likely in the case of the V-shape, it could be because governments are introducing stimulus. It could be that maybe some bright scientist out there may have figured out how to be able to solve the problem or even introduce a cure for COVID-19. And that could be a good reason why you probably would anticipate a V-shaped type. So there has to be something that will change the landscape that will cause the V. If it's not there, then more likely a U or W-shaped type of bottom will take place. Now, as an alternative of a V-shape, you could have something in the middle. This is what we call a square root type of pattern. It starts off like a V, sharp rally, And then it positions itself with a graduated decline, pretty similar to what I showed you earlier to the U-shaped pattern. This again, as you see that the volatility tends to be a bit less wide, and you see that it seems to be more in control, that tells you already that a lot more people are starting to buy their positions back into the market, and you should prepare yourself for prices to be able to move upwards right after that. Now, sometimes taking in the first type of V-shaped pattern may be very difficult. One, it comes as a surprise. Two, it hardly pulls back. And it's because of that that V-shaped type of bottoms will have to introduce something more aggressive into the trader. You have to put in a little claim in there. Never mind if you're not fully positioned, but you want to be able to take an early claim into that as soon as the V-shape is coming in. And normally you will know that the V-shape is probably going to be quite extended because you will see that the price will start breaking above the 20-day and the 50-day moving average already. By that time, the market is feeling much more confidence. And with that confidence will come greater demand. And as the demand becomes much more lasting, then you will see the V-shape attempt to be able to be more elastic than what it was in the prior type of bottom. Now, the final type of bottoming process is what we call a W base. So W base, because what it does is that, again, it's also gradually oriented. There could be some news of a cure, or there could be some news that we're getting close to a cure, but it still leaves a certain period of uncertainty. Or they may tell you that perhaps a cure may be coming out, but we can only expect it into the next year or the next 18 months. Clearly, that could have its own level of disappointment. And so these conditions, because it will still drag onto the economy, you will see that the first rally from a W base will probably come, perhaps create a small W units first, rally, and then come back down to retest the previous low and complete the double base of a W pattern. So if you look at the Metrobank picture we have here, that shows you quite a good sample of what that looks like right there. And so after it does, and it completes a two-level test of support, and then you can see a much more viable option to be able to get in hand. Let's go back to the use of the moving average. If you remember what I told you earlier, if the price of the stock is trading below the 20-day or the 50-day moving average, I told you, more likely you probably want to stay out. Also, if the 20-day moving average is not crossing over the 50-day moving average, it also does not sponsor the idea that you're getting a buildup in demand so much yet. And that's why it's only at this point here where you see that the short-term moving average, the 20-day, crossing over this longer-term moving average, that you see a much more viable trend action come back into a recovery swing. And this eventually is what we're going to be keeping our eye on. The minute we see these crossovers in the 20-day from the 50-day come in, it will produce a much more lasting rally for you, and you can probably trade this with greater confidence. If you're trading the first rallies, looking into it, you will just have to trade it, keep that in the short term, because there could be a second attempt to be able to test support. But after the second test, and you have a combination of indicators working in your favor, you will get a much more substantial impact into the rally of the market. Now, once the market shows you a V-shape, U-shape, or W-shape, and you do get your crossover on your moving average, we will start to see some telltale signs of the market's uptrend is starting to stick. You will see higher highs and higher lows present themselves. The crossover in the moving average will also give you good inclination to keep the positions in a longer period of time, because you have to understand that after a massive sell-off like what we've come through, the advances that's going to come next is going to be quite substantial. And that's why try to be able to prevent yourself from just taking it or selling your positions outrightly. If you want to sell, keep perhaps half or 30, 40% of your position, because the advance that's going to come in the next few months and maybe even the next few years can be quite substantial. All right. Now, as I said earlier on, let's talk about in terms of the strategy for people who are short-term in orientation and the traders who are longer-term in orientation. Now, if you are shorter term in orientation, more likely you probably want to stay out for the meantime or in cash and wait for this capitulated selling to end. One of the signals that you'll probably get is that big volumes will normally come on those capitulation days. And you might also get some patterns appearing. They could be small bases, small W's, small little rectangles. You might get patterns like this to help along. If you don't see a big volume day, it might take that in a matter of several days rather than all in one. Now, our objective over here is really to be able to make sure that we're ready to trade the big bounce that's going to come. However, remember, the first bounce off a rally, you have to learn to take the profit off, because normally trends don't just change and go the opposite direction immediately, even in a V shape. So you want to take some profits the minute the rally starts to fizzle, and then the minute the market starts to pull back, if it shows you a controlled pullback, buy that controlled pullback. If you see it as an agitated decline once again, then just stay back, wait for the market to do another capitulation, and then do the same thing, trade an oversold bounce, and try to take your profit when the rally fizzles. Remember, for your short-term traders, you can buy more aggressively when you see the trend reversals are actually showing their signals already. By that time, you go back into your regular mode, and you can be that lean, mean fighting machine you've been once before. Right now, in a downtrend like this, you want to be able to be quite circumspect, and you have to choose the battles that you take. For the longer-term trader or holder, let's look at it in 2 points of view. If you're still in and you are light, you may want to hold on to your position and wait again for the next buying opportunity, such as, for example, the end of a capitulation, to add to the position. If you're currently too heavy, my advice is, if you see a rally, try to lighten into that rally, regain some degree of comfort into that, and then wait for another capitulation to end so that you can move what you've sold back into those particular conditions. I'm worried that if you're too heavy right now and the market decides to go down extendedly more, you might start to freak out and probably get frightened when prices are much lower, when you should be really looking at the ability to add back into a position. So if you want to be able to gain that level of comfort, do it into a rally and not when prices are just dropping like a rock. If you're currently out of the market, let's shift first into a short-term plan, because remember, the trend is down after all. What we did in the short term is you will just simply stay out, hold out from here for the meantime until a base or a capitulation is shown, and then you can start injecting your positions when you see a lot more technical confirmations that your trend has already been exhausted into the downside. Your objective over here really is to be able to regain value over time. But at the same time, you want to get control back of your position. Because if you're too heavy into your position, you will not be making logical decisions in your portfolio, because the pain might be too unbearable for you. So try to be able to reduce yourself into that stance so that you can gain your composure. I know you are long-term, but I'm telling you, a lot more people sell their positions almost at the lowest point of a market, because even at that point, that's when people become the most fearful. And that, believe me, is where you don't want to sell. So what should I keep in mind in terms of this? First, let's look at this in terms of a survival guide for us traders. 1. Rising tides raise all ships, and falling tides sink them. And what that means is, I know we will be talking about particular stocks in a little while, but remember, understand that if you are in a bearish market or in a bullish market, a bear market tends to engulf everything into a downside. It does not play favorites. It's the fear of the people that will drag prices down. And it's because of that that you might be saying, oh, I'll hold this, or I'll hold this, or a small cap, mid cap, or big cap. But you will see that the intensity from all of them will do relatively the same. Now, the only advantage I see of holding on to the blue chips as compared to the small caps is, after this worst part is over, the first things that will rally will be the more liquid and the larger issues. I would suspect the index stocks will go first, because this is the opportunity that a lot more people out there can actually buy these very, very much in-demand issues at crazy in-demand prices. Second, always wear your life jacket in this market, because you have to protect your capital. Right now, you're in the game as long as your capital is still intact. If you allow yourself to buy too much and you try to be able to survive in a market like this, it might really test your patience. If you end up selling, like I said, towards the lower end of this range, you might not have so much left. So do what I said earlier on, that if a rally comes up, you probably want to get your selling back of comfort and safety by liquidating some positions so that you have more ammunition to take advantage of this just in case the market continues to go down or to retest the low that it's had before. 3, and very, very importantly, if you dare use margin, please use margin wisely. Now, the use of margin is the ability for someone to borrow money from their broker to be able to use that to buy stocks out of their cash value. Now, there's a time and place to use margin. This is not that time. And the reason is because in a downtrend, you have time ticking against you. Interest charges are on the loan that you make, and prices continue to drop down while you're paying interest charge. So if you dare use margin in a market like this, it must be only a small portion of the margin. Don't maximize your margin levels here. Bring it down. Perhaps at this stage, if you're going to do at a maximum, you probably only want to have 30% or 20% for now. And when the market starts to base up or show some bottoming process, then you can always re-inject that later. The last thing you want is to go through a margin call when prices are coming towards their lows. Again, prices can stay down here for an extended period of time, and again, that will just track itself against you if you don't know how to use margin well. Next, pick your trend time frame and stick to it. Now, what do I mean by that? When you're coming out as a trader, you have to decide on the onslaught. Are you going to trade in the short term or are you going to trade in the long term? If you decide to be a short-term trader, then you have to follow short-term rules. If you're going to trade in the long term, then you have to follow long-term rules. So you don't be switching from short-term to long-term, short-term to long-term, or long-term to short-term only because your emotion tells you to do it. There should be some logical sense into it. A typical example would be you trade a stock in the short term, it starts falling down and you take a little bit of a loss, and then you say, okay, I won't use short-term cut loss procedures anymore because I'm already down a little bit, and I'll just hold it in a longer period of time so that eventually I can recover. And in the medium term, prices continue to fall down, and that shakes you out because you get so extendedly feared on the situation, and you end up selling your stock at a much lower condition. So don't change a short-term position, make it a long-term position for the wrong reason. Next, trends take time to turn. You and I are all wanting this market to turn around immediately, and I hope it happens tomorrow. But the conditions we have to be realistic about. Today in society, we're dealing with something that we've never seen before. Some of us never in our lifetime. And this unprecedented event can be, can put us and test our patience to the max. And so if you understand that trends will take time to turn, you probably want to limit your purchases and extend it over time rather than just buying everything one time, big time on a capitulating end. Because one capitulation could actually go through a series of the second or a third or a fourth. So please understand, it takes time to turn around, and in that trend turning around, you have to be able to inject your positions gradually as well. That's the more logical thing to do during this time. And finally, after here we are preparing and planning for everything we're doing, when it is time to act, please leave your emotion behind. That means that if it's time for you to sell a position, do it. If it's time for you to enter a position because the signals warrant it, then do it. Because if you let your emotions always take control of this, then you'll always be finding yourself as a laggard or always in the delay of what the trend conditions is pushing forward. Okay, so that brings me to a conclusion of my subject matter. But I understand that many of you have your stock requests and wanted me to be able to have a look at the technical conditions of some of your favorite stocks. So we took a poll from our Seawell Premium official Facebook page, and we have here your top 10 requests listed out in the order of which that many of you had decided to pull off. We have Jollibee, Ayala Land, Metrobank, MPI, Ayala Core, SM Prime, Megaworld, BDO, PLDT, and Bank of the Philippine Islands. So let's have a look at the technical situation for each of them. Okay, now on the left side, I have a daily chart of Jollibee. And on the right side, I have a very, very long-term chart of Jollibee presented roughly in the next 11, 12 months, 10 years rather. Now I'm drawing these two time frames so you can get a better cast of what to anticipate in terms of potential support. Let's look at Jollibee. So Jollibee just took off on the downside. So here's an example of an accelerated decline that could be leading into a capitulation. MACDs are still pointing downwards, and that tells you that the momentum is still on the decline here, and so it doesn't mean it's automatically going to bottom yet. But the mere fact that I'm seeing price gaps already is telling me that this is already coming closer to an end rather than the beginning of a decline. Also, RSIs are starting to tell me that you're oversold as well. When we're looking at the monthly chart of Jollibee here, you can clearly see the damage has been quite severe. It's gone from this high over 300 all the way up to 95 pesos per share. And given the context of that, we're also seeing very oversold readings into the monthly chart. Normally, when you see very oversold readings in the monthly chart, you really want to get ready to be able to start looking to maybe potentially purchase this in due time, especially when those reversal signals I talked about are coming in. I've also outlined the potential next major support between 95.60 and, just in case things get more harrowing into the decline, 73 pesos into decline. Just keep these targets in mind. I'm not telling you you're going to hit those targets, but just in case an opportunity comes where you see a tag on this or this, then I think it might be worthwhile for those long-term people to be able to start purchasing little by little those levels as well, because our recovery from here can be quite substantial. Now, as a general rule, in a rally situation, this price has the potential to rally to these moving averages which I outlined here. I put a 10-day EMA, a 20-day EMA, and a 50-day EMA. More likely, a rally from this type will probably just touch the first one, maybe and max the second one. So if you're looking for a target in potential, use this as your first target zones. More likely not this yet. Remember, this is just an interim rebound and not a trend reversal yet. Ayala Land. Ayala Land seems to have already started its recovery. Here's the gap that I was talking about. It's almost closed that gap already. And a potential target could be between 31 to 34 for Ayala Land. It's also come from an oversold stage. And if you're looking at the long-term position, it already tracked the first support target I had, which is 23.50, and the next one even was also intraday hit at 20 pesos per share. And I think these are viable levels already to do your long-term gradual accumulation for this. But remember, tone down the aggressiveness because we have no reversal signals as of yet. Metrobank. If you notice the pictures I'm showing you are almost resembling the same type of situation. So again, we're looking at intensification. There was a bit of a gap in here. Prices may, in a rally condition, try to rally between maybe 43, hopefully maybe closer to maybe 46 by the time, and perhaps that be the immediate condition. But Metrobank has fallen almost to the low it's been in 2009. So I really would anticipate major support between 35 to 31 for Metrobank. So keep your eye on those levels. MPI. Now MPI has a little bit of a different trend condition, is because if you notice it had its pattern that it did over here. This was because earlier they announced a buyback situation which allowed the stock to actually recover while a lot of issues were still falling down. But eventually it succumbed to the same type of selling and we've hit new lows as well. So this may not have hit the particular lows just yet, but I hope that in due time it will. The potential rallies from about 290 to 3 may be your first resistance areas. Major support for MPI is between 2 pesos and 20 cents and 2 pesos. Ayala Corporation, I think, has been really sold quite heavily. Again, here's another gap, also highlighting a potential exhaustion. Prices may try to make a recovery back to this moving average or this moving average. So right now it's between 517 to 585. Also coming from an oversold state, both in your daily and also both into your monthly chart. Major support between 350 and 268. SM Prime. SM Prime tried to hold up into its advance for quite a lengthy period of time, but eventually prices did have to fall down. As you well know, malls are also hard hit because of the situation that the plague outside is damaging, of course, businesses into this area. And you cannot congregate in malls anymore, and a lot of closures have taken place. And perhaps it's the reason why it played catch up into the decline. But look at its RSI, a 9 RSI in SM Prime. I don't even recall when I've ever seen that in my lifetime. So this is extremely oversold already. In the monthly, perhaps not as of yet, but if you notice, major support for it is between 20 pesos and 16.30. We did see an intraday low closer to that 20 pesos already. So I hope that this can establish itself as a strong demand point for the meantime. MegaWorld is also another company that's actually gotten hit, perhaps also because of the virus and, of course, the potential pullout of some of the POGO workers. And it's because of this that prices have just been quite slippery. But again, it's also now trading on an RSI of 10, potential rally between 260, maybe back to 3, and that should be able to leave potential upsides. Major support from MegaWorld will be at 2 pesos to about 1 peso and 76 cents. BDO. BDO also had a bit of a gap here, managed to be able to close it on day one, and in the last few days it seems to be holding its ground. So I think this one not really that oversold as of yet because its RSI is at 30, so it could probably recover, but maybe not so much, maybe back to 110, and hopefully try to be able to make a pullback to be able to give us a better opening later. Major support for BDO is between 75 and 56. Again, please remember, when I'm giving you a second support values like this, I really don't think it can hit it, but just in case we see it, just have a little bit of some ammunition ready, just in case that opportunity knocks in our door. PLDT. Now, PLDT, unlike many of the other types of stocks we were looking at, have been on a pretty good uptrend before the decline has taken place. PLDT is a little different. If you notice the situation here, it's actually been falling down since 2015, 2016. It's been on a downtrend since, and I have not seen any reversal trend from PLDT as of yet. So I really think that unless I see a major reversal from this, breaking off this major downtrend line, I would probably just be minimize my puts back into PLDT for the meantime. I see something major take place on its trend change. For now, maybe a rally back within the pattern could suggest something, but it might get itself locked closer between 1,000 to about 1,050. Major support for PLDT is between 900 and 800. And finally, we have BPI. So BPI, just like the rest, have actually fallen down. RSI is about 20, so yes, it's quite oversold as well, but not as radical as the rest. And maybe potential rally could be between 62 to about 69. And if you're looking at major support for BPI, 50, which it hit, I think, partially the other day, and the next one would be about 43 pesos per share. So again, if you can see the typical stocks, many of prices are not even breaking above their short-term moving averages. And as I told you earlier, for the short-term traders, you probably just want to stay out until a rebound starts and then take a little bit of a position to sell it near resistance and then wait for prices to come back down for a retest of a potential bottoming pattern. And we'll just continue to do that until trends change. We take advantage of the rally, but understand it may not be too enduring and that the potential for a base out may still come back. And so do prepare for a major support retest after that. Okay, so that brings me to a wrap up of what I wanted to present to you today. I want to leave you with some words of wisdom. In many ways, the stock market is like the weather, in that if you don't like the current conditions, all you have to do is wait a while. And markets can remain irrational longer than you can remain solvent. For those people who are on margin, please highlight what this means, because you might be pushed towards a condition that might go extendedly into a downside and you might be forced out of your positions. For those of you who still don't have too heavy a position, you've got decision making to make, and just try to make more of a prudent one. We have an opportunity today. Be ready to act when it's ready and when the technical signals come back into place, and don't try to be able to take too much of an early position, because that itself might prove to be quite a difficult thing to stand on. So with that, I'd like to say thank you very much and good luck to our fellow traders and investors out there. I know we're in difficult times, but like they've said before, crisis periods like this will bring out the next opportunity, and it's all about whether we know how to be able to take advantage of it or not. So try to be able to survive this a little while longer so that these new opportunities can come for us to be able to get.